Why is the NASDAQ up 40%? And why is, Bitcoin up 60%? It's because they're already pricing it. Crypto summer comes sometime next year, or that's when things start to get crazy again.
So, you know how we've been chilling through that long crypto freeze? Well, guess what? Things seem to be heating up again. Everyone's buzzing about a possible bull run. It's thrilling to think about the gains, but man, no one wants to be caught off guard, right? Look, no one can perfectly time the markets, if only. But there are some smart moves you can make to ride the next big crypto wave when it comes. Crypto's like a roller coaster, you know? We have those highs where everyone's in a good mood, watching prices soar, and then those lows where it feels like everything's crashing. During those high moments, some folks make big bucks, especially when newbies jump in. But as we've seen, what goes up can come down, often pretty fast. So in this video, we're going to go over the exact game plan you should follow to maximize profits and minimize risk in the upcoming crypto bull run. Before we get started, if you'd like to start trading crypto, please click on the link in the description to open up a Gemini account that will allow you to do so. Let's get started. So, you've heard about the Bitcoin halving, right? It's kind of a big deal in the crypto world. Every 4 years, like clockwork, the prize miners get for helping out with Bitcoin transactions get sliced in half. This means fewer new Bitcoins are popping into the market. Now, here's a fun fact. After each of these halvings, Bitcoin tends to go on a wild ride. Back in 2012, post-halving, Bitcoin went from a modest $12 to a whopping $1,100 in just a year. And after the 2016 halving, it jumped from just under $700 to almost $20,000 in 2017. Some folks are already placing bets on the 2024 halving being the starting whistle for another bull race. It's kind of basic economics. You've got less new Bitcoin coming in, but more people wanting a piece of the pie, so the price goes up. But, and there's always a but, it's not just about the halving. Crypto's a big universe now. There's Ethereum and its smart contracts introducing cool stuff like DeFi and NFTs. Plus, whatever the government decides to do about crypto can be a game changer. All that said, keeping an eye on the Bitcoin halving schedule could give you a heads up about when the next big crypto wave might hit. As of now, the next halving is set to take place early to mid-2024. Typically, the market reaches its highs anywhere from several months up to over a year after the halving takes place. So, now, months before the halving could be a good time to start accumulating for the next bull run. Analyzing past bull markets reveals that while each has its distinct characteristics, common themes often emerge, which can be instructive for understanding future trends. The 2013 rally, with prices moving from around $100 to over $1,000, was primarily driven by speculation as the world began to take notice of cryptocurrency. This early era showcased the nascent market's wild volatility. By 2017, Bitcoin's surge to over $19,000 was buoyed by a mix of individual and institutional interest, spurred by factors such as the rise of prominent exchanges like Coinbase, the fervor around initial coin offerings, ICOs, and growing optimism surrounding the potential of blockchain technology. Yet, it wasn't without its challenges, including allegations of price manipulation and concerns over inflated asset valuations. Fast forward to 2021, and the landscape had evolved further. The bull run was characterized by heightened corporate and institutional engagement, the meteoric rise of decentralized finance, DeFi, significant sales in the NFT art space, and a vast array of altcoins entering the fray. This era even saw meme coins like Dogecoin capturing the limelight, underscoring the undeniable influence of social media-driven hype. Throughout these cycles, several recurring factors were evident: speculation, waves of hype, an increasing tilt towards mainstream acceptance, innovations that broadened the crypto utility spectrum, and an influx of liquidity, often attributed to expansive monetary policies. Moreover, the emotional rollercoaster experienced by investors, often magnifying current price trends, cannot be ignored. Although history doesn't offer a blueprint for the future, recognizing these commonalities provides insights into potential market bubbles reminiscent of the dot-com era. To discern whether market valuations are genuinely reflective of asset value or merely inflated, it's crucial to keep tabs on fundamentals such as development activity, transaction volume, earnings growth, and tangible crypto adoption. By internalizing lessons from these past market phases, investors can sidestep the pitfalls of succumbing to peak hype purchasing. It may also be helpful to think about what the trends for the upcoming cycle might be. Personally, I am looking at the sectors focusing on artificial intelligence, scalability solutions, and advancements in the DeFi and NFT sectors. Bull markets in the crypto realm offer tantalizing opportunities for investors to reap significant gains. To truly harness this potential, it's essential for investors to look beyond the dominant force of Bitcoin and consider a diverse range of assets, both established blue-chip cryptocurrencies and the more nascent ones showing promise. While Bitcoin undeniably plays a pivotal role, often influencing the trajectory of the broader market, there are altcoins that have demonstrated the ability to surpass Bitcoin's growth rate. A case in point is Ethereum, which made notable strides against Bitcoin in the 2021 rally. Additionally, other smart contract platforms, such as Solana and Polygon, exhibited remarkable growth during this period. Investing in burgeoning ecosystems, be it the world of decentralized finance, DeFi, or the realm of non-fungible tokens, NFTs, can grant investors a front-row seat to some of the most groundbreaking developments in the crypto sector. Beyond this, delving into the practical applications of crypto and blockchain technologies in diverse fields, ranging from supply chain management to gaming and social media, can reveal projects ripe with potential. However, it's crucial to strike a balance, juxtaposing the stability of time-tested coins against the allure of emerging cryptocurrencies teeming with growth prospects. For instance, while Bitcoin might offer a twofold increase during a bull surge, some lesser-known altcoins might amplify their value tenfold or even 100-fold. Allocating small portions of one's portfolio to these potential breakout stars can yield disproportionately large returns, but caution is paramount. Altcoins, despite their allure, also bring along heightened risks, particularly when the bullish fervor wanes. Steering clear of pitfalls like thinly traded cryptocurrencies, those built on untested technology, or the ones driven merely by memes and hype, can save investors from undue risk. In essence, a judicious portfolio approach would be to anchor investments in reliable blue-chip assets, complemented by a selective mix of high-reward candidates. During bull markets, emotions like euphoria and greed can often cloud judgment, setting the stage for mistakes that many investors later rue. In such exhilarating yet precarious times, it becomes paramount to prioritize the security of one's investments to sidestep the pitfalls of theft or deceit, especially when the market is buzzing with activity and peak valuations. One fundamental step for those holding cryptocurrencies long-term is to leverage hardware wallets, ensuring that private keys remain impervious to external threats. Storing substantial sums on exchanges is a risky endeavor, given the perpetual threat of cyber hacks. The utility of multi-sig wallets shines here, as they necessitate multiple authentications for any transaction, bolstering security. And while bull markets are times of optimism, they also attract opportunistic scammers in droves, with phishing schemes becoming all the more rampant. Investors, particularly those new to the game, must exercise discernment, trusting only legitimate sources for app downloads and remaining wary of deceptive wallet apps and other malicious software. Additionally, with regulatory bodies often intensifying scrutiny during these bullish periods, it's wise to stay abreast of any legislative changes within one's jurisdiction. While decentralized exchanges may offer a semblance of privacy, circumventing Know Your Customer (KYC) protocols, they aren't devoid of risks. Moreover, seeking expert advice on tax implications and reporting of crypto gains is invaluable. In this digital age, adhering to online security norms is non-negotiable. This includes employing robust, unique passwords, enabling two-factor authentication, harnessing antivirus solutions, using VPNs, and encrypting devices. And remember, private keys and recovery phrases are sacrosanct. They must never be divulged publicly or be left vulnerable to dubious links. Ultimately, In the roller coaster world of cryptocurrencies, safeguarding one's assets is just as critical as seizing profit opportunities. By marrying judicious investment strategies with stringent security protocols, one can truly thrive and navigate the unpredictable waters of the crypto realm with confidence. In the exhilarating world of crypto, bull markets surge with electrifying momentum, only to eventually peak and pave the way for subsequent drawdowns as the initial exuberance dissipates. Astute investors understand this cyclical nature, and they strategize to capitalize on gains during these upswings, aiming to sell before the inevitable crest and following descent. Utilizing technical analysis proves invaluable here, as it can illuminate potential resistance points, hinting at when a rally might be nearing its zenith. Key indicators to watch out for include dwindling trading volumes, surges in derivatives being liquidated, and the prevailing market sentiment transitioning from unbridled optimism to trepidation. Given the unpredictable nature of these markets, pinpointing the absolute peak is a near impossible feat. A prudent approach is to stagger your exits. This might mean divesting in increments, selling, say, 20% of holdings when your asset doubles in value, 10% when it quintuples, and so on. Such a strategy ensures that you ride the uptrend, all while securing profits at different stages. Once you've sold, consider transitioning the proceeds to stable assets. This could be stablecoins known for their steadiness, established cryptocurrencies like Bitcoin or Ethereum that traditionally experience lower volatility, or even converting to fiat currency, keeping it on standby to capitalize on any forthcoming market dips. It's paramount, however, to resist the siren call of holding onto or even purchasing more assets during the market's manic highs. Setting clear exit benchmarks in advance, adhering to predetermined price thresholds, and reining in emotions are the keystones of executing a disciplined selling approach. Just as strategic buying is crucial, so is strategically shedding assets during upturns. It's a dual approach that bolsters both risk mitigation and the preservation of one's wealth. As we navigate the exhilarating ride of crypto, the allure of the next bull run beckons with immense profit possibilities. Yet, the true winners will be those equipped with sound strategies and a keen understanding of market cycles. Leveraging insights from past rallies, maintaining a diversified portfolio, and having airtight security and exit plans are pivotal. But while the potential gains are intoxicating, a balanced approach is crucial. Remember, no bull run is eternal. By planning wisely and tempering excitement, one can not only relish the highs, but also safeguard their gains against future market uncertainties. If you'd like to get started in crypto, please click on the link in the description below to create a Gemini brokerage account for free.